In this video, I want to talk a little bit about decision making and how we think managers should make decisions. Hopefully, they make good decisions for us, but we want to understand some of that process. Again, this is a very loose summary of what the primary objectives of decision making by managers in a company, what they should be. So what is the goal of the firm? Well, what does the firm want to do? And what this refers to is the investors give the company money. These are creditors and shareholders. What should the company do for those investors, right? This is the goal. Managers are working for the owners. What do the owners want? Well, another way of asking this or phrasing this, I guess, is what benchmark should managers use when they're trying to decide how to implement a project or reject it, right? What should they be thinking about? Is there a benchmark that is an appropriate measure for that kind of decision? And there are primarily two basic thoughts, two basic goals that management can employ and certainly that they pay attention to. The first one is they can maximize profits. How this works is they say, when they analyze a project, they say, okay, if we do this project, will that provide the maximum profit for the company? Or they could maximize share price. Maximizing share price. If I do this project, will the stock price increase, and will it increase as high as I can get it to go? Those are our two primary choices. So which one should we choose? Well, the theory, right, the current thought is that we should be thinking about maximizing shareholder wealth. If you think about this, think about a sole proprietor. Would a sole proprietor do anything that did not increase their personal wealth? Now, the confusing part of this is that we frequently confuse profit and wealth, right? Wealth refers to the stock price. Profit is an accounting mechanism, right? Profit really isn't real. It's a number at the bottom of a line, right? So in most cases, right, owners invest in companies in order to increase their personal wealth. So if I'm doing this, I'm doing what the shareholders want to be done. Now, this doesn't mean that trying to find high profits is bad, right? It's good, right? But the challenge is it's not a good variable in the decision-making formula, if you will. Why isn't it a good formula, a good variable? Well, it really doesn't reflect anything about the timing of profits. When do they occur? Are they today kinds of profits or are they later kinds of profits? Profits essentially are a backward-looking vision, if you will, right? They look at what has happened. They don't look at what we think will happen. And profits do not apply to cash flows. As we'll see in some of our later videos, cash flow is the primary variable that we use in the decision-making process. Cash flows and profits are not equal. And finally, profit itself does not address the question of risk, right? What is the uncertainty that these events that we think are going to happen, what is the uncertainty of them actually happening, right? So profit, again, I just want to kind of go back. Profit is good, but using it to decide to move forward or not is not the best variable to use. So let's continue with this a little bit. If you maximize shareholder wealth, we're going to consider cash flows, when those cash flows occur, and the riskiness of those cash flows. Again, this is primarily what owners want. And after all, this is why they buy stocks, to increase their wealth through the stock value. So we have a basic formula that shows the share price equals the future dividends. Now, future dividends are cash flows. It's cash the investors receive. This addresses both the level and timing of cash flows, divided by the required return. Now, we'll have lots of discussion a little bit later about returns, but in this required return is the risk of the cash flows. Now, these, as you remember in a previous video, this is all perceived, right? This is what the investor perceives they're going to receive. So let's talk a little bit more about these decisions, right? Managers are naturally inclined to act in their own best interest, right? There is an economic term, this is called a rational decision maker. But the point here is that it's not always the same interest as the shareholders. But how can we get managers to act the way we want them to act, right? How can we get them to act more like what owners want them to do? Now, this is not that they necessarily will be doing illegal things, but we do want them to be good stewards of our investment dollars. So how can we do this? It has to do with compensation. We need to compensate them the right way, right? If they're not doing what shareholders, there can be direct intervention by shareholders, right? Shareholders can step in and do things, right? They can threaten to fire management. There could be a takeover attempt if they don't do the right thing, right? So many of these things are actions that we as owners can take to get managers to act the right way. What we're really talking about here is something called the agency issue. Whenever a manager owns less than 100% of the firm's equity, a potential agency problem exists, right? In theory, managers would agree with shareholder wealth maximization. But again, managers are also concerned about their own personal wealth, job security, their fringe benefits. So this can cause managers to act in ways that might not always be in the best benefit for shareholders. What about a relationship between shareholders and debt holders, right? Stockholders, right, are more likely to prefer riskier kinds of projects. Why do they want riskier projects? It's because they perceive an upside, right? Upside benefit if the project succeeds. Again, bondholders get fixed payments, so they're more interested in making sure they get their payments. So they want safer things, right? So again, bondholders are concerned if companies want to borrow more money. So they provide things in the contracts that will constrain managers' actions, maybe limit some form of additional debt, if you will. But there is a conflict between what stockholders want and what debt holders want. So how can we balance this, right? How can we put this all in perspective, right? The primary financial goal is shareholder wealth maximization. Then this translates into maximizing stock price. The value of any asset is the present value of its future cash flows. This is a fundamental valuation formula. Most significant decisions are evaluated in terms of their financial consequences, not just current, but these are actually their future expected financial consequences. So stock prices change over time as conditions change and as investors get information about a company's prospects. Managers recognize that being socially responsible is not inconsistent with maximizing shareholder value. So what do we mean when we say socially responsible? Well, there's some context or some similarities in current business programs. Some courses refer to this, or some programs refer to this concept as corporate social responsibility or social awareness, and others more traditionally refer to this as ethics, right? So what does ethics have to do this, right? Ethics are standards of conduct or moral judgment, right? Violation of these standards, right? There can be lots of things, right? Most recently, we've heard things like creative accounting, right? I've even heard the term aggressive accounting. Well, what's aggressive accounting? When I learned accounting, we always talked about accountants should be conservative, not aggressive. We could try to manage earnings, provide misleading forecasts, insider trading. All of these types of actions all refer to as ethical dilemmas, right? And negative publicity from those kinds of things often lead to negative impacts on a firm. So how do you know if something is ethical or not? Well, I happen to listen to a lot of Warren Buffett, and I'm going to paraphrase this, but Warren Buffett once said, again, just to put this in context, somebody would come to him and ask them if something was unethical. And Warren Buffett once said that the mere fact that you come to me and ask me if it's unethical probably means that it's unethical. But put this in another context, right? If what you're going to do is in the newspaper tomorrow and your mother was going to read that article, how would you feel? If you think she would be very happy with you, then it's probably an ethical decision. If not, you know the answer. The answer is it's probably unethical. So again, that's the end of this video. I look forward to talking to you in later videos. Have a good day.